Warm welcome to this month's edition of our market commentary, where we reflect on economic and market forces shaping investor sentiment both globally and in India. In September, trade uncertainty continued to impact the domestic markets, offsetting the impact of policy reforms and US Federal Reserve rate cut. Meanwhile, the RBI kept the rates steady while lowering the inflation estimate for FY26. So let's dive into this month's market outlook. The US Fed reduced the key rate by 25 basis points and signaled the possibility of 2 additional cuts in 2025. This move comes amid mounting pressure from the Trump-led administration to aggressively lower rates. After holding steady since December 2024, the Fed finally acted, citing growing signs of weakness in the labor market. It is important to note that monthly non-farm payroll additions in US averaged approximately 130,000 numbers over the past 3 months, which is well below Q1 FY26 run rate of more than 2 lakh numbers. We believe that US Fed's move doesn't signal a shift in the stance to aggressive monetary easing. The future policy decision will predominantly depend on how the labor market fares and the consumer price moves. Inflation still remains a key concern for Fed officials. Policymakers acknowledge that inflation has ticked up and continues to stay elevated. However, for now, the softening job market appears to be the bigger worry. In fact, US CPI rose 2.9% as companies passed on the cost stemming from Trump's tariff policies. The passing of tariff impact could be a key driver for inflation numbers going forward. Global markets responded positively to the rate cuts and shifting trade dynamics. Demand for non-US assets surged, with China once sidelined re-emerging as a favorite. The Hang Seng Index rose 7% in September 2025, while South Korea and Mexico also saw rallies. US markets gained 2%, buoyed by expectations of a rate easing cycle. Also, if you look at the year-to-date returns, emerging markets emerged as clear winners. MSCI emerging markets rose around 25%, broadly matching MSCI Europe and outpacing MSCI World. Overall, these strong gains reflect a combination of local policy easing, improving growth visibility, and better positioning for global disinflation and liquidity rotation. Indian markets struggled to maintain momentum initially. A combination of GST reforms announcement, the US federal rate cut, and reports of constructive trade talks between India and the US had propelled the markets by 3%. However, the positive sentiment quickly faded, with the Sensex ending the month with a modest gain of 0.6%. A mix of persistent and emerging challenges is dampening the sentiment. The ongoing earnings slowdown and the impact of US tariffs continue to hurt. Fresh headwinds from the US are adding pressure. IT stocks came under the stress after the US hiked H-1B visa fees, which could squeeze margins for Indian IT firms. Pharma stocks plunged following Trump's 100% tariff on imported branded and patented drugs. The Reserve Bank of India kept the key repo rates unchanged amid declining inflation and robust economic growth. The RBI increased India's GDP growth estimates to 6.8% for FY26 from 6.5% earlier. At the same time, it lowered the inflation estimates for the fiscal year to 2.6% from 3.1% earlier. We believe that the inflation environment will continue to remain benign. The headline CPI for retail inflation was at 2.1% on year-on-year basis in August 2025 while core inflation eased to 4.1%. The GST rationalization has reinforced the likelihood that price pressures will stay contained. As a result, the RBI has ample of room to cut rates in FY26, broadly in line with the global easing cycle. Gold surged to record highs in September 2025, reinforcing its role as a safe haven amid global trade tensions and policy uncertainty. A softer US dollar and expectations of further Fed rate cuts are supporting the rally. Meanwhile, silver prices has also benefited from the expectations of Fed rate cuts. Also, the demand for silver has outstripped supply for the fifth consecutive year, sending the prices soaring. Also, note that silver is used in various industrial activities, including clean energy technologies like solar panels. Brent crude has stayed range-bound, mostly below $70 per barrel. Concerns over a global slowdown and steady supply have capped any upside. For India, subdued oil prices help to reduce the import bill and support the disinflation narrative for H2 FY26, offering relief on both inflation and current account fronts. In the current global environment, we favor domestic-oriented companies over export-oriented ones. Private banks, select large players continue to trade below long-term average valuation despite stable asset quality and earnings growth. Capital market and exchanges, benefiting from strong GDP growth, financialization of savings, potential proliferation of ETFs, and increased equity participation. Cement, industry consolidation and retail consumption is driving a balance between volume growth and profitability. Defense, infrastructure, and manufacturing. The Make in India push and PLI schemes are empowering domestic capital goods firms to compete globally. Automobiles, positive on two-wheelers and select passenger vehicle OEMs, supported by rural demand and easing input costs. Auto ancillaries offer resilience across cycles, being less affected by shifts in brand preferences. Healthcare, especially hospitals, with just 1.4 beds per 1,000 people, far below the WHO benchmark, India's healthcare infrastructure offers long-term growth potential. Private players are scaling rapidly, gaining traction over the past decade. Also note that these sectors, especially financial services, automobile and auto components, cement and healthcare, are expected to be the direct and indirect beneficiaries of recent GST reforms. At ASK, our house view remains firmly tilted towards large caps. We see strong earnings durability, macro resilience, and valuation comfort here, especially as India's valuation premium faces scrutiny and overall earnings growth was slowing across market cap segments. Historically, during the periods of uncertainty, large cap segment has always outperformed small and mid caps by a significant margin. Strong balance sheet, deeper institutional ownership means that large caps are better equipped to handle volatility than small and mid cap stocks. With global policy uncertainty, tariff risks, and uneven earnings still weighing on sentiment, these defensive attributes matter the most today. Thank you for your time. We'll connect with you again next month.